Okay, now we continue with the last part of chapter 6. And this is the section on page 145, duration-based hedging strategies. So let me tell you what this is about. Now, two extremely important asset classes are equities and fixed income securities. And we have a large number of funds over there that invest in a large equity portfolio or a large fixed income portfolio. Now, you can see in the case of an equity portfolio, as the stock market goes up, you get a little worried. Is there going to be a correction in the market? If you anticipate a correction in the market, you might say, I want to sell some of my stocks, move out of the market. However, if you're a large equity fund and you sell a large portion of your equity portfolio, what's going to happen? The market is going to respond by dropping, and you don't get your anticipated gain. Okay, so the way you hedge against downside risk, right, after the market has gone up, is by taking a short position, a short position in the S&P 500 futures contract. This is what I showed you in chapter 3. Hedging an equity portfolio by trading in S&P 500 futures contracts. Quite briefly, if you have a long position in an equity portfolio, you take a short position in the S&P 500. This is an example of cross-hedging, right? You can't find a futures contract in your specific portfolio, but because your portfolio is fundamentally related to the S&P 500, they're both the key risk in both those factors is market risk, which is common to both. You can adopt a cross-hedging strategy. So this was the whole example about jet fuel and home heating oil and stuff like that, that was then applied to your stock portfolio and the S&P 500, again an example of cross-hedging. But the basic idea over here is I illustrated an extremely important hedging strategy that's employed by virtually everyone that has an equity portfolio, any institutional trader that's trading an equity portfolio. Also understand that the S&P 500 futures contract is the most heavily traded contract in markets, in US markets and worldwide markets. But the key point over there is, if you remember, what we had was your portfolio had a certain beta. And then we took a short position in the S&P 500 to try and change the beta of your portfolio, either down by 10%, 20%, or all the way down, reducing it by 100%, reducing the beta to 0. So the bottom line was this: the risk of an equity portfolio is given by its beta, and a short position in the S&P 500 allows you to change the beta of your portfolio in a tunable way. That is, it can get it to any beta you want, from 1.5 down to 1.4 to 1.3, continuously all the way down to 0, depending on how heavily you want it to hedge. Okay, now the second class of portfolios that's, fixed income portfolios, and there are a large number of fixed income portfolios out there. The question is this: suppose you're managing a bond fund, and interest rates have gone down, and your bond fund has gone up. Now, not just now, interest rates could have gone down, and see the value of your fund has gone up. Now, strictly speaking, bond portfolios can go up for a combination of reasons, two of them. One is, the Federal Reserve constantly lowers the risk-free rate. So the risk-free rate goes down and the value of your portfolio goes up. But the value of your bond portfolio could also go up if credit spreads narrow. So for example, if you invested in, say, high-risk bonds, right? And as the market gets stronger and stronger and stronger, or the economy gets stronger and stronger and stronger, labor numbers look good, GDP looks good, right? People get more and more comfortable with investing in riskier and riskier investments. So you're more likely to invest in high-yield bonds, not worrying that it's going to take a hit in a good economy. So what happens is the credit spreads between high-risk and low-risk bonds, or high-yield and investment-grade bonds, the credit spreads narrow, right? And when the credit spreads narrow, your high-yield bonds go up in value. Okay, so in general, bond portfolios can go up in value either because treasury rates decline or credit spreads narrow. Okay, and that usually happens, you know, I guess they don't necessarily happen at the same time, right? Because usually in bad economic times, where the Federal Reserve is trying to help the economy, right, they lower interest rates, right? And during that time, credit spreads are wide. It's only after they lower the interest rates and the economy begins to pick up that credit spreads narrow. So anyway, those are the two reasons why bond prices could go up in value. Declining treasury rates or decreasing credit spreads. Now, of course, if you've invested in a bond portfolio, when either treasury rates decline or credit spreads narrow, the value of your bond portfolio goes up. Now suppose we're expecting a problem in the economy, right? And the problem results in either, most likely, credit spreads widening. What would happen? Your portfolio will take a hit, right? So when interest rates go up or credit spreads widen, that's not to say they happen at the same time. You have to do the macroeconomic analysis to find out, because the Federal Reserve plays around with interest rates to help the economy. That's the treasury rate they play around with to help the economy. And credit spreads respond to the risk of the market or the anticipated risk of the market between high-risk bonds and low-risk bonds. Okay, so now suppose your bond portfolio has gone up, up, up in value, right? And you're worried, I need to move my money out of the bond market into money markets, right? So I want you to see the comparison between equity portfolio and the bond portfolio. The equity portfolio, your stock portfolio has gone up in value, and you want to move some money out of your stock portfolio into money markets. In the bond portfolio, again, the same thing has happened. Your bond portfolio has gone up in value, and you're worried it's going to decline, there's going to be a correction. So you want to move some money out of your bond portfolio. Okay, how do you achieve that? Well, again, look at the comparison. When we spoke about equity markets, the risk of your equity portfolio was measured by its beta. And you hedged your portfolio by reducing the beta of your portfolio. Think about that and come to the bond market. For a bond portfolio, the risk of your bond portfolio is measured by what? Just think about it for a second. The risk of your bond portfolio, I want you to think about a right answer, and when I give you the answer, ask yourself whether you got it right or wrong. Okay? The risk of a bond portfolio is measured by its duration. Okay? Generally, the higher the duration, the higher the risk of the bond portfolio. Lower the duration, the lower the risk. Now, over here, we're talking about interest rate risk, right? The higher the duration, the more sensitive it is to interest rate fluctuations. The lower the duration, the lower the sensitivity to interest rate fluctuations. So over here, you have interest rate risk as measured by the duration of your bond portfolio, right? In the previous case, the stock portfolio, you had equity risk or market risk measured by the beta of your portfolio, right? And over there, we changed the beta of your portfolio by taking a short position in the S&P 500 futures. Over here, if you have a long duration portfolio, and I presume you would have a long duration portfolio because if you were trading bonds in anticipation of interest rates going down, 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 right? The longest duration portfolio would have given you the highest upside. So now you've capitalized that upside, but you're stuck in a long duration portfolio. And if interest rates now begin to rise, what happens to your long duration portfolio? It gets hit big time, right? So you need to hedge that risk. Now, when I say hedge that risk, that means you want to hedge the interest rate risk. And the interest rate risk is measured by the duration of your portfolio. And therefore, what you want to do is reduce the duration of your portfolio. So, summarizing this, in chapter 3, in chapter 3, you had a stock portfolio, okay, that was measured by its beta, and you hedged the risk by taking a short in the S&P 500 futures. Now, in chapter 6, we have a bond portfolio. The risk is measured by duration. And what is the position you take? You take a short position in Treasury bond futures. So that's the counterpart. So you can see, right, since the stock portfolio and the bond portfolio are two major asset classes, all right, and a large number of portfolios fall into these categories. Of course, there are many others, like I told you, you can trade currencies, commodities, and all that stuff. But these are two very large asset classes. And I'm trying to draw a parallel over here in terms about the risk of each portfolio, beta, and you manage that risk by taking a short in the S&P 500 futures. Over here for a bond portfolio, the risk is measured by its duration, and you manage the duration or the risk of this portfolio by taking a short position in Treasury bond futures. So that's what we illustrate over here. So now I want everyone to go to page 147. Actually, no, 145. Okay, section 6.4 reads, duration-based hedging strategy using futures. So that's what we're going to do. Now, there's a lot of stuff in that section. I mean, you can spend a lot of time reading it and you'll come to the same conclusion of what I'm going to tell you next. So just pay attention to what I tell you next, and what we're going to do is go straight to example 6.6 to illustrate that. Okay, so let's start writing some stuff out on the board. Okay, it is August 7th and a fund manager with 10 million invested in government bonds is concerned that interest rates are expected to be highly volatile over the next 3 months. So let's draw the timeline over here. It's August 2nd, right? And over the next 3 months, what is the fund manager expecting? Until November 2nd, right? This is what we're expecting. Let's look at interest rate volatility. Interest rate volatility is this, and over the next period, we're expecting interest rate volatility to be this. So we're expecting high interest rate volatility. And when you expect high interest rate volatility, if you have a fixed income fixed income portfolio, right, with a high duration, you can imagine if interest rates go up, the value of my portfolio goes down. If interest rates go down, the value of my portfolio goes up. So essentially what we're expecting is a lot of variation in my portfolio. So it's unnecessary risk that you're trying to avoid, uncertainty in which way bond prices are going to go. So to try and hedge that risk, right, you want to reduce your sensitivity of your portfolio to interest rate fluctuations during this period. Right, you're standing over here, remember? You're standing over here, looking forward, expecting this volatility to rise, and therefore you want to decrease the sensitivity to interest rate fluctuations. In other words, you want to decrease the duration of your portfolio over that 3 months. Let's keep reading the question. Okay, the fund manager decides to use December T-bond futures contracts to hedge the value of the portfolio. The current futures price is 93-02. So the futures price, okay, the futures price over here for a contract that matures when? Okay. Okay, now, strictly speaking, you'll go with a how many month maturity futures contract? You'll go with a 4-month maturity contract. Does it say that over here? Okay. So remember, this is 3 months, you're expecting uncertainty, so you go with a 4-month futures contract. Okay, and the futures price, it should be this. The futures price is given by 93-02. Okay, and remember I told you there are 4 types of futures contracts. There is the 2-year, 5-year, 10-year, and the T-bond contract. So remember, each contract will have a different maturity for the cheapest to deliver bond associated with it. So you really have to look at, if you have a really long duration portfolio, then you would have to go with what? A long maturity futures contract, which is the T-bond contract. If you have a shorter duration portfolio, you might consider a 10-year, 5-year, or 2-year treasury bond, treasury contract, futures contract to hedge your stock portfolio. So really, which contract you go with, the 2-year, 5-year, 10-year, or the T-bond contract, will really depend on which one closely matches the duration of your bond portfolio. But in this case, he goes with the T-bond contract. Okay, and the current price of the contract is 93-02. Now 93-02, remember in your 34.3 class how bond prices are denoted. -32 refers to 93 and 2/30 seconds. And 93 and 2/30 seconds can be written as 93.0625. So that's the futures price. And the futures price, the futures price is always given, the price of bonds and futures prices are always given as a percentage of par. Okay? And the Treasury bond futures contract, the T-bond contract, is to deliver $100,000 par value of bonds. Okay, where does that come from? Remember when we did corn futures, right? A standardized contract was to deliver 40,000 bushels of corn. When we studied gold futures, a standardized contract is to deliver 100 ounces of gold. So, like when you trade one round lot of common shares, a standardized round lot is 100 shares, okay? If you go with one contract of options, the standardized contract is, one option contract is to buy 100 shares of the underlying stock. So these are just, the standardized contracts are developed based on what they think people would find suitable given their needs, okay? So in this case, one Treasury bond futures contract, the standardized contract, is to deliver $100,000 par value bonds. Okay, so that's the size of the contract. So if each bond had a par value of 1,000, right, then the standardized contract is to deliver 100 bonds, because each bond has par value of 1,000. 100 bonds on that would be $100,000 worth of bonds. Okay, so the futures price is always given as a percentage of par. And for futures and for the T-bond contract, we're talking about delivering $100,000. So you can write the futures price in dollars as 100,000 of that. 93.0625% of 100,000. Percent of 100,000, which is 93,062.5. So when we see a futures price of 93-02, what it means is this: the futures price is that many dollars. Okay, now you have $110 million worth of bonds. Okay, now suppose start with assuming an identical hedge. Okay, strictly it's a cross hedge, but what I want you to see is, like in the case of the hedging your stock portfolio, I said first consider the identical hedge, and then what is the impact of the cross hedge. You use the optimal hedge ratio to determine how much you hedge, right? So over here, an identical hedge would be what? Would be you hedging your portfolio which has a certain duration, by taking a short position in a bond that has exactly the same duration. Now, what is the likelihood that if your portfolio has a duration of say 9 or 8, what is the likelihood that you'll be able to take a short position in a portfolio in a bond with exactly the same duration? Right? You're not going to get an exact same duration, and therefore what you'll have to do is account for the duration differentials, and that will result in a cross-hedging sort of thing. But let's set aside the cross-hedging first. Ask yourself, if this were an identical hedge, right, what short position would you have to take? And the answer to that is as follows. Because you have $10 million worth of bonds, right? If you take a short position in one futures contract, it'll allow you to unload $93,062.5 worth of bonds. Is that clear? Because that's the futures price. Okay? So if I divide 1 million by this, that'll give me the number of contracts I have to short, right? And I could unload my entire bond portfolio. Except, now let's account for, if this was an identical hedge, that is, both the long position in your portfolio, the duration of the long position of your portfolio, and the duration of the cheapest to deliver bond on the futures contract, if those two durations are the same, right, then it's an identical hedge, and you take so many short contracts, and you're done. But it's not, right? In your case, the duration of your portfolio, let's look at what the duration of your portfolio is. It's given as, suppose the duration of the bond portfolio in 3 months will be 6.38. So the duration of your portfolio is 6.38 years. All right? And the duration of the cheapest to deliver bond is what? Is 9 points. So the duration on the futures contract is 9.2. Okay, so what we have is a bit of a mismatch in the duration. So let's see what the implication of that mismatch is. Suppose I went with the identical hedge, right? And let's look at two scenarios. Interest rates go up or interest rates go down. Okay, now let's look at the portfolio and let's look at the futures. So this is the short futures contract. And this is the long portfolio position. Okay? So the duration of the portfolio is 6.8. If interest rates go up, how does your portfolio perform? Right? If interest rates go up, all portfolios drop in value. But your portfolio has a relative short duration, so when interest rates go up, its value will drop by a small amount. Okay? Now, you have a short position in the futures contract. When interest rate goes up, your long position drops in value, but your short position goes up in value. Right? If you have a short position in a bond, what happens? You make money when the value of the bond drops, right? Since the duration of the cheapest to deliver bond on the futures contract is high, your short position goes up a lot. So what is the net effect of your combined positions? It goes up a little. Now look at what happens when interest rates go down. When interest rates go down, your long position goes up in value. Your long position has a short duration, so it goes up in value, but a small amount. Right? When interest rates go down, your short position in the futures contract does poorly. Because when interest rates go down, bond values go up. And if you have a short position in a bond, what happens? You get killed, right? But since the duration is high, you get killed by a large amount. And what is the net effect of that? So you see, if I follow this identical hedge, because there's a duration mismatch, the duration mismatch creates a problem. It doesn't keep you fully hedged, right? Because when interest rates go up or down, what you want is, you want both of these to be zero. If both of those are zero, that means regardless of which way you go up or down, your combined position has no sensitivity to interest rates. But because of the duration mismatch, there is some residual sensitivity to interest rates. So you need to account for that. How do you account for that? Well, look at this. Your futures contract is more sensitive than my portfolio. So what do I need to do? I need to hedge fewer contracts. Okay? So same thing over here. My futures contract is more sensitive to changing interest rates than my bond portfolio. So I should hedge fewer contracts. If I hedge fewer contracts, then my short position, my net short position, because I have fewer contracts, won't go up as much. Do you follow? And then you get a perfect match over here. So I have to hedge fewer contracts. How do I figure how much fewer contracts? According to the proportion of their dividends. I mean the durations. Okay? So what happens is when I hedge with this, so this is the optimal hedge ratio. The optimal hedge ratio is simply a ratio of the spot to futures. Okay. So if I evaluate this, what do I get? When I evaluate the first ratio, I get, evaluate the whole thing, I get 79.42. So in other words, to hedge my bond portfolio of 10 million, I have to take a position set in, I have to short 79.42 contracts. Okay, how easy can that be? Okay, so that ends chapter 6. Okay, so in terms of the number of problems that you should be comfortable doing is, you need to be summarizing this. You need to be able to solve for the accrued interest, solve for the conversion factor. You need to be able to solve the problem about the cheapest to deliver. You need to know how to determine the arbitrage-free relationship between spot and futures prices. And you need to know how to use treasury bond futures to hedge the interest rate risk of your bond portfolio. Okay, so it's very precise what I want you to know. All of these things have an important practical importance, okay, that I want you all to learn. Okay, so we have one additional chapter to do after this, which is chapter 7, swaps. Okay, so I'll send this out to you all, and over the next few days, I'll create the next lecture on swaps, which will be in probably 2 or 3 parts, and that should bring us to the end of the semester. Okay?